Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by American Note Buyers. Now, here's your host, Justin Bogard.
Welcome to episode number 13 of the Be the Bank podcast. And today I've got Richard Thornton with me, and we're going to be discussing a few kind of subjects. One in particular being about title insurance, why you need to get it and what happens when you don't get it. And there's a couple of transactions in between of that. We also want to get into a little bit of debate on what are the pluses and minuses as it pertains to a loan that has a large down payment with a short pay history versus a loan that has a low down payment with a long pay history. Stay tuned. Hey, Richard.
Mr. Justin.
Is it hot out there in California?
No, it's not. It is a nice day, but we are having the weirdest summer. I mean, it's supposed to be right now 90 degrees and shorts and t-shirts and blah, blah, blah. The last 2 days have been cold and blustery. And when I say blustery, I mean 15 to 20 mile an hour winds that are gusty, and you'd think you were in the first days of March. I mean,
oh, wow.
Like, wait a minute, it's cold out here.
That's interesting. Yeah, we've been fortunate enough not to have a lot of wind. It rained a few times already, which has been helpful, but overall it hasn't rained that much. And we're definitely hovering around the 80-degree temperature every day with very low wind. So it's actually good golf weather. If anything, we can take a positive out of it. Besides the drought.
Did you play golf this morning or yesterday or when?
I played last weekend.
Mm-hmm. And how did you do?
I did not do very well at all. It was a pretty poor performance, I'd have to say, on my part. If that was a day to play skins, you probably would have taken my bankroll.
I see. Okay.
Yeah, pretty bad.
Right.
But I will be playing a few more times this week. So,
well, that's good.
Yeah.
That's
For those of you listening to us babble on here, don't forget to check out our YouTube channel, American Note Buyers, so you can see the video stream of this podcast. Brought to you by American Note Buyers.
Mm-hmm.
Richard, I brought up a minute ago in the little opening monologue about title insurance. Mm-hmm. We were fortunate enough to have our friend Brenda Flatter come on our monthly broadcast that we do live on our YouTube channel and our Facebook page.
Right.
She talked a lot about kind of I won't say generics, the basics of title commitments and policies, and kind of just give us a roundabout idea of kind of how it works. I kind of requested that she do that for us in our audience because, quite honestly, Richard, I was never really taught about title policies and title commitments. It's kind of just one of those subject matters that they just give you all the documents and you're expected to know what you're reading and understanding it. Mm-hmm. It's almost like, I don't know how to explain it, but did you feel that way too when you first got into real estate? When someone said, "Here's your title commitment, sir," what do you think?
No, I knew it all from the first day. I knew it all. No, I still am. Unfortunately, I read through the highlights and then my eyes start to glaze over, and I say, "Okay, Mr. and Ms. Title Agent, is everything here?" And they nod their heads. They say, "Okay, fine." That's kind of
what I do appreciate about the escrow agents, closing agents, whatever they call them at whatever title company you use, is that they, in my experience, they often will give you like, "Justin, this is what we need to clear to close. We need number 1, number 3, and number 12 to be cleared." And you look at those items on the schedule and you're like, "Oh, I get it. That's easy."
Yeah.
So I like that part of it, but it's nice to have her run through and be like, "This is the exception. This is what they'll guarantee. This is what they won't insure. Obviously, they're not going to know if anything's not recorded at the time that they give you the insurance. They can't help that, right? That's not their fault. How unprofessional, Richard. Turn off your phone.
Yes.
My gosh. It's like you're a marketing person or something. Taking
Could
sales
you
calls.
imagine? Can you imagine?
Can you imagine? So I don't know if I brought this up on live before, but I'm in the process of trying to get a piece of land for one of our trusts.
Mhm.
And that piece of land is being sold to me through, I would say, like a land wholesaler.
Right.
And the land wholesaler had found this little parcel and then was able to resell it on seller financing. So they did a land contract. So
Right.
they're actually on the deed, and then they created a land contract, and the person trying to buy it that's gaining equitable interest, they are paying installments monthly until they pay it off in like 3 or 4 years.
Mhm.
And then they get the parcel free and clear, and they get the deed in their name.
Right.
So in the process of me buying this, especially in my trust, I don't take any chances. I go through, very rigorous steps, even though it's a very low valued opportunity, meaning it's like under 10,000. I still go through a title company, and I want to get the insurance to make sure title is clean and clear.
Right.
And I also want to get kind of a loan policy to make sure that the lien is in first position. Again, this is my trust. This is, I make sure I dot all my I's and cross my T's, because I don't want any issues in my trust.
Right.
So I get a preliminary title report from the title company. They list out, several things, and 4 of which are the last 4 kind of deed transactions that happened with this piece of land. So I look into it and I read the person I'm buying it from used an LLC. Okay, that's fine. The person they bought it from was like individuals. Okay. And the person those individuals bought it from was an LLC. And the person before that the LLC bought it from was another set of individuals. So all those transactions, Richard, they happened without going through a title company and without getting title insurance. Now, it's not illegal to not use a title company.
Right.
You don't get the advantage when the deed is changing hands so many times, because you want to insure that title. So because I want to get title insurance, because I want to ensure that this title is clean and clear, and everyone that it transferred for, no one can claim that they own this piece of parcel, this piece of land in the future, I want it to be insured. So in order for the insurance to be, in order to clear to close, or for the insurance title company to insure the title, we have to go back and figure out how to contact these people to have them sign an affidavit. Basically saying like, yes, I was present, and this is true and accurate,
Right.
types of things. And the LLC has to provide, some sort of operating agreement that shows that the signer on that signed on behalf of the LLC was actually allowed and able to do that on behalf of the LLC.
So how are you going to do that?
That's a great question. How are you going to do that? So all this happened within a span of, I'd say, 4 to 5 years. In this transaction, I think there was 4 transactions. So you have to make the decision. Are you going to make the effort and go back and try to hunt these people down, skip trace them, so that you can get them to sign this affidavit? And it's really simple. It's just a document. It reads exactly what it says. It says, I was the grantee or the grantor on this date, and this was the parcel that I was in the transaction with. Very simple, and they can do an online notary. But the hard part's finding them, right? If there was somebody that oh yeah, I know this person, I can get a hold of them. Yeah, it's easy, but more than likely you don't. These people are in California or other places across the country, and I'm in here in good old Fishers, Indiana. So you just have to make the decision now. Justin has to, if I want to go through with that and try to figure that out, because the title company is not going to be able to provide any more help unless it was closed at that title company at some point, which obviously it wasn't, because there wasn't title insurance. So they can't really help at all. So it's just one of those things to where you got to get it done.
Right.
So if this transaction didn't happen between me and this wholesale land person, they are on the deed, right? This LLC, and they have a land contract out there with some borrowers that are going to pay them, and they're going to pay them off in like 4 years. I think that's what the note term is.
Okay.
So Richard, what happens when they pay them off in 4 years? Well, you're supposed to give them clean and clear equitable title at the end of the land contract, so you can cancel it and they become the deeded owner.
Right.
So you're going to have the same problem then, because you need to insure that title for them.
So you might as well go ahead and, it would seem to me to be easiest to work the chain and go back to the previous person, the previous person, the previous person, because each one of those people will have the other's contact information, right?
Correct.
And while
Correct.
it's laborious, I mean, in actuality, now that I hadn't thought about this, but I sold a note to one of my clients that had a defect. And it was state of Georgia. And in state of Georgia, if your notary statement doesn't say that the person is basically in the presence of the notary as opposed to just, it's invalid. So we had to go through 5 levels of owners to find out who these people were. Fortunately, I knew how to get a hold of all these people.
Yeah.
And so I sort of became the central person to get it all done. But it had to be done. And it was about a 2-month process.
Yeah. So I'm sure this happens way more often than we realize. We're not aggressively in the vacant land business to trade notes or to buy them, but you and I both bought a few.
Right.
And with this one experience, it really made me think about it this week and say, you know what, this probably happens very often. And there's kind of a struggle here with the person that is the wholesale land buyer, because I want to be able to defend them and also want to be able to curse them at the same time, right?
Sure.
Because they're running a business, all right? Maybe they're buying a couple hundred of these vacant land lots across the country a year.
Mm-hmm.
And if you get title insurance on every single one, that's a lot of money just in title insurance, right?
Right.
And the transactions are probably really small. Sometimes they're like maybe a few $100, $500, $1,000.
Mm-hmm.
So I get it. They're small transactions, and the cost of getting title insurance totally outweighs the purchase price of what you're trying to do.
Right.
But like you said, at some point, you're going to have to get title insurance, or maybe someone else does down the line. Maybe it's not their problem, and maybe that's how they see it.
Mm-hmm.
But it does become a problem. And so I can see the land business having a lot of issues with title because of that.
Yeah. And I think also for this reason, and I'm sure there's other ones, a lot of title companies won't do land contracts because, there is the owner is someplace in the chain that can't be found, and it can, in fact, they can't insure it over it, so they can't do the deal. So why bother with a bunch of smaller deals, right?
So that was my experience and my epiphany this week.
You are learning more and more every day, my son.
A young grasshopper.
Little grasshopper, yes. Some days I feel like the grasshopper more than the other. Sometimes it comes with an oh crap,
Right.
I feel like, how did I not know that?
Let's switch gears to a different topic now.
Sure.
We have brought this up in the past, and we haven't really dived into it super deeply. So let's get into a debate today, and let's figure out where we land on what side of the fence that we're on.
Mm-hmm.
So in the performing note world, we see notes that have very large down payments, meaning like 20, 25, 30% down payments. And if you're listening to this podcast, you say, really? It's not uncommon to see those large down payments. It's just, they're going to be from more or less the people that aren't bankable, but they have sizable down payments.
Right.
As opposed to somebody that gets conventional financing on a house in the several $100,000 range. They probably don't put 20% down. They probably get like 2 mortgages and stuff. We're talking about the homes that are probably under 150K.
Mm-hmm.
So you got those people with very large down payments with no seasoning buying those notes. And then we have notes that we have very little down payment, like maybe 5%, under 10%, but have like maybe a 3, 4, 5 year seasoning of pay history on them. So
Right.
the question is, Richard, which note do you prefer, and what are the pluses and minuses to them?
Well, let's put a little more spin on it, which is, I know the ones that we're looking at that don't have any seasoning are also newly renovated. So if somebody walks up to us and says, hey, I'd like to sell you a note, there's 25% down, but there's absolutely no renovation on the property, depending on the condition of the property, it may or may not give me pause to buy that note. And I'm also going to want to know more about the buyer. Have they been a renter? Have they been a renter in a long period of time in one place? Can we get a rental history payment history from them, be it canceled checks or whatever? I mean, that's sort of acts and walks and talks like a rental history, like a payment history.
Yeah. Right.
I mean, we all have to keep in mind, buying a new note, the old game that Harbor got in trouble with years ago, right? Maybe they would sell a house to somebody who had a minimal down payment, and they're going to improve the house with sweat equity. And they later found out, because they lost a number of court cases, that those people had no ability to raise the money to do the sweat equity. Right. So basically they were buying, a substandard house. So we have to be very careful of that if we're going to buy something that's newly purchased and unrenovated.
Yeah, so I don't know if I can put an A+ grade on either of them, and that would outweigh each other. I would say kind of how you dive into some, you put a spin on it, on which one would be better. I think they both have their merits, and I think they both are good, and we buy both of them. And it ultimately comes down to, I think, what you said, I'll key in on it, was what's their propensity to repay?
Right.
And what's your risk, really? So if somebody puts down a 30% down payment and you calculate what the property value is today, and you're at like a 70% investment to whatever the true value is of the property, well, that's a pretty decent discount, when you're looking at it, and you feel pretty well protected to get your money back if you had to go for foreclosure.
Right.
So it would take a longer payment history with someone that had a smaller down payment, let's say a less than 10% down payment, so that it looks like there's a lot of equitable interest for the borrower at some point, and maybe it balances out to close to the same, but it may take more than a few years to get to that point. Maybe it takes 6 or 7 years, because sometimes these excuse me, amortizations on these smaller loans are going out 20 to 30 years. So the payments are really small. They might be under $500. Right. So the amount of principal they're actually paying per month is very small, and the amount of interest they're paying is a lot. So maybe it's a $500 payment, and maybe $50 is principal and $450 is interest. So it's going to take a lot of $50 payments to really chew at the principal balance of the loan.
Right. So I guess I'd have to say, all things being equal, if somebody brings to us, which we've seen a number of these, say a wholesaler or a renovator, a buyer who's putting 20 to 25% down, and a house that's newly renovated, meaning not just a bunch of slipshod stuff. If we get good pictures, interior pictures, and we can see that the kitchen was renovated to a good standard, the bathrooms were redone, the house is wholly, painted, probably new flooring, maybe or maybe not a new roof, and the yard is in good shape, I'd say I'd rather buy that than some of the other ones we have in our portfolio, where we've got 2 or 3 years payment history and the house is kind of run down. Because if you look at the scalability, that newly renovated house is going to be a whole lot more saleable, certainly for the next 3 or 4 years. And by that time, you will have established a payment history.
Yeah. If there was like the perfect scenario, that's how I would describe it too. A newly renovated property that's, everything's up to date with a really large down payment and a short pay history. That would be the cream of the crop. And I would agree too. Usually the pay history, when you see it's a long pay history and a short down payment, usually the house is not as attractive as the other. So yes, I would agree. It makes you feel more comfortable when you have a newly renovated house. Now, I will tell you, the marketplace says there is more of an abundance of small down payment, long pay history loans out there than there are of newly originated loans that are newly renovated homes with large down payments.
Right.
So it almost becomes a unicorn for those types of loans.
Right. So one of the things I find out here, though, and actually as we're marketing more in the Southwest, is largely Latinos and immigrants who can't get a regular mortgage, but they can put down very large down payments because they're working the trades or whatever, and they're just taking the money and putting it in a bank, and they don't really know where to invest it. I think I may have explained to you that I had some help out here doing the renovations of my backyard and got to know the guys really well, and really would like to work with them towards buying a house, partially because of a do-good type of thing. But when push came to shove, I found out that really these guys were working hard. They're working about 6 days a week, but they were making $100,000 to $120,000 a year.
Wow.
And they had like $30,000 or $40,000 in the bank, and they weren't sophisticated enough really to know that they should put it into stocks and bonds and things like that. And they were legal. They were legal immigrants, but they would much rather put that into a house. And for somebody like that, I would lend to them all day long. Hardworking, they've got that much money in the house, and they want to be there for a long time. That's a good loan.
Yeah, there's a pride factor to them, right?
Right.
You had mentioned something before we got on the recording here, and that was oftentimes you hear people being confused or not understanding a clear definition of what a sub-performing loan is versus a re-performing loan.
Yes.
And I think we want to set the table here for this. And so the simplest definition that I can come up for a sub-performing loan is that you have a performing loan until it doesn't really perform. And then the next category is really sub-performing. So if it's not paying every month, it doesn't have to pay on time. If it's not paying every month before the next due date, we call that a sub-performing loan, meaning they're either going to get caught up or they're in between a performing and a non-performing. That's kind of the sub-performing category.
So what about a consistent slow pay? In other words, somebody who pays, but they're always 60 days late.
Yeah. So they're paying 2 months worth of payments every 60 days and they're getting caught up. That's going to be a good definition of a sub-performing loan.
Okay. And so what about, I'm trying to be a little bit exact here and give examples. What about somebody who is in our portfolio right now and she doesn't pay for 3 or 4 months, and then she pays and comes current, and then doesn't pay for 3 or 4 months again, and then pays in advance for 2 months, and then doesn't pay for a month or two, and then makes one payment. And so basically is very erratic. What is that, sub-performing?
That'll be a new category called a sub-non-performing loan, because they reach that non-performing status. So once somebody does not pay for 3 months in a row and you don't have any payments come in, they get kicked over to what we call a non-performing status. And that's really when we can accelerate the default clauses in a note and or land contract. And so we can try to initiate the foreclosure process or reach out and hopefully do some loss mitigation with them. But that does happen. And we do have one in our portfolio to where they do just get caught up all of a sudden and they just kind of ride the wave for a little bit. So they're kind of in between a sub-performing and non-performing. So that doesn't happen very often, but yeah, you can say they're either way. You can say it's a non-performing loan, or you can say it's a sub-performing loan, and you can be really accurate by saying both.
So what's the difference in pricing?
So if we were buying it, obviously that pay history erraticness is extremely important to view and look at it over a long timeline. So if you see that happen recently and in the past, maybe they had a pretty consistent pay history and they paid every month, but all of a sudden you realize something's going on in their life that's causing them either to almost lose their house, or they're just in a current struggle in whatever life cycle they're in right now, and they just need help getting caught up, and they'll probably stay caught up in the future. So you kind of have to take a gamble with that one. So it would be priced lower because you're uncertain as to what's going to happen once you buy it. So if someone was consistent and this is their MO, like you said, they pay every 60 days, they pay 2 months worth, then we know what's going to happen and we see it being habitual, then we're not going to price that too low, but we're going to price it a little bit lower than if the loan was paying every single month on time.
Mm-hmm.
Because for those of you that haven't experienced owning a note, you do get the benefit of getting late fees as well. That's
Right.
written in the note. So those late fees are going to continue to add up, and that's going to be more money in your pocket as well.
Now, so you're having this note serviced by XYZ servicing company. Who gets the late fees?
It depends on the servicing company. Some servicing companies say that they get all the late fees and you have to accept that. And most servicing companies just do a 50-50 split with you. And there are a few out there that actually give you the entire late fee.
Mm-hmm.
I can't think of any off the top of my head, but I've seen it in the past where they would give the entire late fee to the lender, which would be the note owner.
I can think of one that gives you the entire late fee. Okay.
So now a reperforming loan.
Mm-hmm.
So a reperforming loan is a loan that has gone through a default, and they have remedied the default by basically renegotiating the terms with the lender or coming up with some sort of probationary period to say, I just need to show you I'm going to make this many payments consistently in a row, and then I want to alleviate myself from possibly being accelerated into foreclosure. And
So wait a minute,
those
do
are
they have to go
reperforming
through a
loans.
default though, or what if they just didn't pay for 6 months and then they got a job and they started paying and now they're paying fine, but they hadn't paid you for 6 months?
Yeah, that's going through a default. So the definition of default is when they go beyond 30 days, they're in default technically.
Okay.
So once they reach the non-performing status, as we alluded to earlier, about 3 months not paying, they're in non-performing status. They're just not performing.
Okay.
And so
I'm
after
trying to delineate something there for the
Go ahead.
audience, which is that you are terming default as a time period as opposed to an actual notification or certification by documentation.
Yeah, there's many different ways. Time is one of them.
Mm-hmm.
Not paying your taxes or your homeowner's insurance is another way to default.
Mm-hmm.
And then obviously not making your payment is a way to do a default.
Okay, so if you haven't bought your kids any ice cream for 4 months, then you have defaulted on your ice cream allotment for your kids.
Yeah,
And
there was a contract. It was in there.
Real big doo-doo, right?
Yeah, depending on how little they are too,
Okay.
because they won't forget it.
Oh, no, they won't.
You didn't get ice cream that one day.
That's right.
I asked for it.
That's right.
So that's the difference between a subperforming and a reperforming loan.
All right. Well, that's a good delineation. I hope that's helpful for people.
Hope it is too. All right, Richard, we are out of time for today's podcast, episode number 13 on season 5, Be the Bank podcast, brought to you by American Note Buyers. I'm Justin Bogard. This is my co-host, Richard Thornton, and we will see you guys on the next episode.
Great. See you then.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our channel on YouTube and follow us on Facebook and Twitter at Be the Bank and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by American Note Buyers. Thanks again for listening.